Welcome back to another real estate market update for the greater Milwaukee area, this time July and August 2021. It is hard to believe we're already in the third quarter of this year. The first half of the year is already over. Time goes so fast, and what a first half year it was. It is a heck of a market. It has been very challenging, but we also have seen a lot of really good changes. And also for us, it has been a really good first half of the year, 44 closed transactions so far, something I'm very happy about and also happy for our clients because, like I said, it has not been an easy market, but we're on track to hopefully 90 to 100 closed transactions this year. So what's on the agenda for today? I want to talk a little bit about what's been going on in the last few weeks. We are seeing the market shifting. It's become very apparent in the last 2 to 3 weeks, so I want to talk a little bit about that. I also want to talk about inflation and wage growth and interest rates and how these things are tying together into the housing market and are putting a little bit into perspective what we are seeing currently in the housing market. It's very deceptive. The general media is portraying a little bit of a I shouldn't say inaccurate picture, but it's difficult to compare numbers with last year because it was such a untypical year. So you see some crazy differences when you compare 2021 to 2020 because of the impact of the pandemic that we had last year. So we're going to talk about everything that you need to know if you are on the fence, if you want to do anything in your personal real estate space in the next half year, in the next year. We are going to get you the information here that you need to know about what's ahead and what we possibly can expect from the near future. But before we go there, let's take a quick look and see what's going on with the single family home market in the greater Milwaukee area. Lots going on here, so let me walk you through here. We have here the June numbers from MLS. Inventory is still down 17%, but that is a huge improvement. Remember, we've been down 50%. Homes sold are up 20%, so with less inventory, we are selling more, which, of course, no surprise, is the hallmark of a very competitive market, and because of that, prices are going up like crazy. 10.9% is the median price change for the total Southeast Milwaukee MLS. If you break it out to Milwaukee County, pretty much the same picture. Inventory slowly catching up, still down. And we are selling almost 30% more than we did last year around this time. And prices 15.68% up, now 214,000. Now, let me put that a little bit in perspective with numbers from 2015, because that gets to show you really what's going on here. We used to have about almost 13,000 homes for sale on the market. So there used to be a lot more to choose from than we have currently. Buyers have to make up their mind really quick and then make a very strong offer. Look at this number here, 2,600 homes sold compared to 3,300. So with a lot less inventory, we are selling a lot more homes. Good news for homeowners. Median home prices have increased 162,900 back then, and now we're at 255, and that is in, 6 years basically. So that's not too shabby as in to pick up some extra equity just because you happen to own a home. So what's going on with the market in general on a very high level? We have a very hard competition going on between millennials and baby boomers. So baby boomers are downsizing. They're looking for smaller homes now, and inadvertently they're competing with millennials who are looking for their first home. And the problem for the millennials is that baby boomers are very savvy. They come usually with a lot of cash, so oftentimes they make cash offers with no financing, which makes for a very strong offer. And they're also not so worried about home inspections, because if you have owned 5 or 6 homes in your life, you're generally not so worried anymore, and they're a lot more likely to make an offer without a home inspection. So for millennials, baby boomers are very tough competition. I've seen it firsthand just yesterday. I was showing a house in Wauwatosa, 2,000 square foot ranch home, perfect for a baby boomer downsizing, and also a great first home for somebody who's buying their first home. So that's tough competition that is happening. That's what's driving the market at the moment. So it's really a shift in the demographics that is creating all that demand that we're seeing, and that demand is not going away. I already mentioned market is deceptive because 2020 is not a good benchmark. Better to look back a few years in the past for benchmark numbers. But the good news is the gridlock that we've seen on the seller side is opening. So people used to say, we don't want to put our house on the market because there's just nothing out there to buy. We don't want to be homeless once we sold our home. Now they're seeing more and more inventory, which is giving them the comfort that they can put their home on the market because there's going to be something that they can buy, which is going to create even more inventory. So we're seeing a positive self-enforcing development there that's giving us more inventory, and that is desperately needed. What I'm also seeing is that landlords are selling. So a lot of them have been stressed because of the eviction memorandum. They didn't get rents. So they're taking advantage of higher property prices and they're putting homes on the market. And we're seeing it when we're renting out properties. We just had 2 vacancies that we rented out again, and we've been overrun with applicants. And a lot of them have told us that they have to look for a new place because their landlord is selling. So that's also adding to inventory. And it's also good because I like seeing people that are traditionally renting. I like them seeing getting into home ownership. That's good for the neighborhoods, and that's good for Milwaukee. We are also seeing over the last weeks is some sort of a buyer's fatigue. I'm going to get into the details with that, but there's a lot of people that have started giving up on buying a home because the first half of the year has been so difficult and so hard to get an accepted offer. So why is it so difficult? You can see it here. Sold to list price ratio, usually around 95, 96% in a normal market. We're at 106%. So any home that is staged, updated, looks cool, will sell for at least 10% over asking price, provided that it's priced correctly. And about 60-65% of the homes are. So this is why you see such a strong number here. So when you're making an offer on a house and it's a really cool house, you have to make a really strong offer. And the price is not the only thing. So I've heard this from another major brokerage in Milwaukee that their agents are writing 7.1 offers to get one accepted. I think that is extremely frustrating for the buyers. Actually, I think that's also frustrating for the agents. They're not making money writing offers for nothing. So I think you're not doing your job as an agent. You should give your client at least a 50-50 shot when you're buying a home, 50-50 chance. And price is not the only thing that you can do on an offer to make it attractive for a seller. So it's not just making crazy high offers. That's not the strategy. You have to make really smart offers. So inventory is going up, and this is what the media is talking about. Inventory is increasing strongly. Yeah, that is true. But keep in mind, we're here at 1,000 listings in Milwaukee. In 2015, we had about 3,600, almost 4,000. So we're still a far cry away from, or light years away from having a market with lots of inventory, which would mean that price appreciation could start to ease off and flatten. So, and this is a chart that shows it even better because the news are talking about inventories rising. This is what they're talking about. This is months inventory of existing homes. So in real estate, we measure inventory in terms of how many months of supply do we have. If we get no new listings, how many months will it take to sell everything we have? And at the moment, as a nation, we're at, under 2. So yeah, inventory is coming up, but look where we have been historically, or where we have been around the 2008 years. So yes, inventory is up, but not very much. So take this with a grain of salt when you read it in the news. This is not a Wisconsin phenomenon. So we're seeing inventory going up on a national level, 8.8% on average in the US. There's a few outliers. We're just a little ahead of average at 11.9% more inventory, which I think is a good place to be. That's solid. In the southeast and also in the southwest, it's summer, so that's, they have 100, 110 degrees down here, a lot of humidity down here. They have droughts. So it's not the really good time to put homes on the market down there. This is maybe where the southern numbers are a little bit lower. Hawaii is the only one that's seeing a negative with minus 3.4. So inventory is generally rising, which means that the market is loosening up. Like I said, sellers are generally more willing to put their home on the market now. They've been waiting for a long time to do this and to upgrade into a bigger home. That's what we're seeing a lot of people are doing now. But we also are dealing with the realities of buyer fatigue. So if you're not familiar with the term, is buyers will get to the point where they're just flat out exhausted and they're giving up. Market has been very challenging. We have seen record price appreciation, extremely low inventory. and record high percentage sales over list price. So this is really tough. If you don't know what you're doing, then you can get burned out in this market very, very quickly. And also we have historically low mortgage rates. We'll talk about that in a second. Now, here is the results of a survey, the Home Purchase Sentiment Index. And in the last months, I've been paying attention a lot to the sellers because that were the bottleneck. The shift that we've been seeing in the market now is on the buyer side, because a lot of buyers are saying it's not a good time of buying a home anymore. Only 35% think it's a good time to buy a home. So this is the buyer fatigue I'm talking about. I believe they will be coming back. I'm hearing it from our clients because they're saying, wow, there's so much more inventory popping up on MLS on every day. We're providing MLS access to our clients so they can look on the MLS for themselves. If you're interested in that, then just reach out to me, send me an email or a text message, and we'll get you set up with MLS login. So as far as buyer activity, this is where we're currently at. If you're a subscriber to my channel, you're probably familiar with this chart. In orange, we have the buyer activity in Wisconsin from this year, and it started out super strong. It was the strongest year of the last 3. And then we came down a little bit, and now we're ranking somewhere between 2019 and 2020 in terms of buyer activity. This is the typical 4th of July drop, and we're now here. And the question is where we're going from here. And I think there's 2 scenarios. One is that we're going to remain very, very strong on the buyer side, but somewhere between 2019 and 2020. And the other scenario is that because we have more inventory, we're going to see buyers that have already given up come back to the market, and we're going to see an increase in buyer activity. In any case, the market is very strong. It remains very strong. So if you hear about the market cooling off, that only means that we used to go 120 miles an hour and now we're going 110 miles an hour. That is still crazy fast. In terms of offers, that means in February, March, we were sometimes competing against 15, 20 other offers. Now last weekend on average, we had 3 accepted offers. Last weekend we were on my listing, we had 5 offers. And on the offers that I've written, we were in competition with 3 or 4 other offers, the best I can tell. So it's gotten a lot easier because you have a little fewer buyers spread out over more listings, which brings the level of competition down. But we are, make no mistake, still a very crazy hot market. So it's always important to keep things in perspective. Talking about that, let's take a look at housing affordability. So with home prices going up, affordability is also becoming more difficult. So here we have an affordability index from the NAR, and when affordability is getting more difficult, this index is going down. So a higher number means affordability is better. And you can see here that we used to be at about 174 earlier this year. Now we're down to 158. That is because home prices are increasing. So this index is measuring what does an average guy need to spend of his income with an average mortgage to buy an average house. And so with home prices going up, now of course affordability is coming down. But we are still a lot higher in affordability than we have in the 20 years here, basically from in the 90s and the early 2000s. So this is kind of the historic norm here. So we still have, even though prices are going up and affordability is coming down, we are still seeing very, very high affordability on average. And what helps with that are mortgage rates. So we are back down at below 3%. The industry was expecting about 3.5% for this time of the year, and we clearly missed that mark. We are back down to less than 3% for a 30-year fixed. That is about the best you can get if you have perfect credit. So if you have average credit, you might be at 3 1/8, something like that. Historic, the norm was about 6.5%, 7% interest rate. So anything that is less than 4 is crazy low. Let's take a look at the forecast. So at the moment, Freddie Mac, Fannie Mae, the Mortgage Banker Association, and the NAR are forecasting here for the next 12 months until summer of 2022. The mortgage bankers are the most pessimistic. They see higher rates, but if you take the average of all 4, I'm getting about 3.5%. So a slight increase from where we are today, but not that much. The interesting thing about this is that we have now 30-year fixed rate mortgage rates that are below inflation. If you've been watching the news, consumer price index is at 5.2%. So you can borrow money for less than the inflation is. And when it comes to inflation, inflation is not necessarily good or bad. It's just what it is. But it has a different impact on your savings than it has on your debt. So inflation will generally reduce the purchase power of your savings. So 5% of inflation means for $100 you've saved, a year from now you can buy less than 5% less than what the $100 will buy you now. But if you have a $100,000 debt on a mortgage, on a fixed rate interest mortgage, it also decreases the purchase value of your mortgage. So your mortgage is shrinking because of inflation. So it's really not good or bad. It's just depending on what your financial picture looks like. If you're more on the savings side or more on the debt side, but both of them will be reduced because of inflation. And when you look back, this is the first time in about a decade that we have seen 5%. And the Fed is saying right now this is just temporarily until the supply chains are caught up and until we get a grip on pricing, on consumer pricing. But we will see, what shakes out. We definitely don't want to go back in the hyperinflation that we had in the 1980s. But there are also some people that are saying inflation is here to stay. And the ones that are making this argument, they're pointing towards wage growth. So if you Google 2021 wages, you find a ton of articles how wages are going up this year. Some of that is pandemic related, but it doesn't really matter why. If wages are going up, people have more money, they can spend more, then prices are going up, then wages are going up, and it becomes that cycle. So this is why I'm saying very important that we keep an eye on what wages are doing now in this year and how that compares to inflation, because that will give us an idea of what's going to happen next. In terms of equity, those are really impressive numbers here. Equity has skyrocketed across the nation. We are seeing, let's start here, $33,400 in average gain of equity on mortgaged homes. So just for owning a home, your net worth has gone up on average in the US $33,400. And if you own a mortgage home, on average, you should have an equity of $216,000. So that is a lot of future purchase power for consumers. And that is only the homes that have a mortgage, because 38.2% of US homes actually are free and clear. They don't even have a mortgage anymore. But when you think about inflation being higher than mortgage rates, I question a little bit the benefit of being actually mortgage free. That's just a little bit food of thought. And in total, we got 1.9 trillion of increase in equity in the last year. So that's really good for consumers. What's the forecast for home prices for the next 5 years? This is a home price expectation survey where real estate professionals, institutions, and analysts are being surveyed about what they expect. And everybody seems to think that this year we're going to see a continuation of the home price increases. In Milwaukee, we've seen more than this in the first 6 months of this year. So we might end up with over 10% again this year in Milwaukee. For next year, they're predicting still a lot of home price appreciation, but a lower number. And then they're predicting we are going back to historic norms. I think that these guys are being too pessimistic. They have been over the last 2 years. When I've been comparing this with what actually is happening, they're being conservative. In any case, all of them are continuing to predict that home prices are going to continue to appreciate. The question here is only, are we going to see more historic norms, or are we going to see appreciation that is going to be higher than historic norms? And that comes down to demand and supply. We've discussed already, and if you're subscribed to my channel, you've heard me talk a lot about the demographic shift that is causing that demand that we currently are seeing. None of that demand is going to go away once a family has decided they want to buy a home and stop renting. I don't think they're going to go back on that very easily. They're going to make it happen, if not this year, the next year. So that's where the demand is coming from, and the supply is just, well, we haven't built many houses in the last 10 years. So until we start building affordable houses on a large quantity scale, we are not going to see appreciation coming down. that's a very likely scenario. So nobody can predict the future. I can't predict it either, but when I'm looking at the data, I think that is very likely to happen, that we're going to see a continuation of home prices going up. Now, if that is true, if these numbers that you've just seen are correct, if you're buying a $350,000 house today, that means by 2026 your house will be worth $443,000. So you got about $93,000 of net worth at stake if you decide to become a homeowner, or if you decide to upgrade on your home. Now, here's my outlook for the greater Milwaukee area specifically. So be careful with the numbers, be careful with what the media is telling you, because yes, inventory is up, but you have to put that in perspective. We're still extremely low, and 2020 is just not a good benchmark. It was a COVID year. 2021 market has not peaked out yet, I believe, so the best is still to come. Usually we're peaking end of May and June. I think this year we're going to peak later, because we're seeing more inventory, which is sparking more buyer activity than we already have. And because of that, we're going to see home prices continue to go up, currently about 1% per month in Milwaukee. So there is a penalty for waiting, and people are seeing that. If you've been on the market for half a year, you've seen home prices go up with your own eyes right in front of you. So there is a penalty for waiting, and this is why people are pushing to get a house under contract. So the market will remain to be hyper competitive, and buyer activity I'm expecting to increase towards August and September again, because people are seeing more inventory, which makes the odds of getting a home under contract better. It's good news for buyers. But also keep an eye on inflation. So we will have to see. The Fed says this is only temporary until we're caught up with the supply chain. There's other experts that are saying, well, let's be careful with that. If wages keep going up, then we might see a continuation of inflation. And when you're looking at home prices, you have to, in my mind, you have to deduct the inflation. So when home prices go up 10% and you got 5% inflation, then the real value gain of the home is only 5%. Real estate is a hard asset, and that generally favors it when soft assets are under pressure. Then hard assets are generally favored by investors. So that's speaking for a continuation of a strong real estate market. If you have any questions or comments, or if you disagree with me, I always love it if people are challenging my assumptions or my conclusions, then feel free to put the comment below here on YouTube in the comment section. I answer them personally, and I try to answer them within 24 hours. I also see a lot of people contacting me after I post a video. So if you want to chat with me, if you have questions, if there's any way I can help you in your personal real estate world, feel free to send me a text message. My contact information is right here. Or you can also send me an email, and we'll be in touch. With that, I hope you're going to have a great rest of the summer, and I'm going to see you very soon right here on the channel.